Hello everyone, welcome again to another financial analysis video with myself, Moeed Amin, and my colleague, Ted Wayman. Today we're going to be looking at a very interesting company, a company called Arqit Quantum. Now, this is a British company, and they are in the cybersecurity space. So, what they talk about is, the fact that current methodologies of cybersecurity, they were fit for purpose back in the 90s and early 2000s, not really fit for purpose now, especially with quantum computing coming around. And, symmetric keys are considered a provable way of, really upgrading the cybersecurity for the internet, for our devices, etc. Now, Arqit claim to have a solution to this, and they have kind of, what do they call it, 4 geostationary satellites that is part of that solution to create almost a cybersecurity platform as a service. And really the idea is symmetric keys are, even though they're considered provable, they claim there is no real safe and efficient way of being able to scale that across, and they claim to have that solution to do so. What is interesting is that a gentleman by the name of Tahir Al-Gamal, he's considered the father of SSL protocols, so the current kind of well-known security protocols. He's actually a consultant for this company. So interesting that he's joined them. We're going to go on to the financial statements. We're going to help you analyze and look at, what do their finances tell us in terms of their story. And we're also going to look at the share price. So stick around for that at the end, because, the share price is an interesting move. In 4 months, it actually quadrupled before going back down again. So we'll talk a bit about that later on. What I will share is that this video came, or this company came from a request from David Best. So David, here is your video, and thank you for requesting that. And by the way, you too can make this request. So don't forget to like, share, particularly if you found this video useful and if our other videos useful, do share that with your community, and also subscribe, because if you do make a request to us, and about 90% of our videos come from requests, as a subscriber, you will get instant notification when we publish it. So Ted, let's take it away. Let's share with our viewers what we found about this company's finances, some quite interesting ones. And I think we'll see an interesting one from the very beginning actually as well.
Well, good to see you, Moeed. Yes, thank you very much. I have to admit, your introduction almost kind of fried my brain. So it is quite complicated. So I'm not an expert in cybersecurity and what these guys are doing. We are just looking at the financials, and the financials we're looking at are quite out of date. So if you do want to kind of say, oh, Ted, your presentation is out of date, I know it's out of date. We are looking backwards, the latest set of, well, if you look on their website, quite interesting, these guys, if you look on their website under the investor relations, you can't find any accounts. And I have to admit, I still find it, just unfathomable today that any new company under its investor relations would never put up its sets of accounts. For me, that's like the fundamental thing. It's like, how can you value a company without looking at the fundamental numbers and working out what it is you're actually buying into? So these guys, you're not going to find this on their investor relations tab on their website. However, it's a UK company. UK companies list all of their accounts with Companies House. So all you got to do is go and visit Companies House, and you will find the financial statements for this organization. Here they are. So let's pull them up onto the screen, and then we can actually have a look at how this company is performing. So here we go. Arqit Limited annual report and accounts for the year ended 30th of September 2020. Okay, so this is over a year out of date. We're now December 2021. And so we are expecting in the next few months to get an update to these. Okay, so this is all I've got to go with. I'm sorry that they are out of date, but when they produce the new numbers, maybe we'll look at revisit these guys. So lots of things will have happened since these numbers, and if you want to update us and tell us what's going on in this company in the kind of latest, then please do use the chat and help us to kind of understand where the company is now. But what we're going to do is look at the financials for the year ended September 2020. So here we go. So the first thing we notice, quite interesting here, is these guys, there's no revenue. Okay, so the revenue, the sales is zero. They are, however, making other operating income. So not an insubstantial amount of 1.5, million pounds. So about 1.5 million pounds of other revenue, not kind of core revenue, but other operating income. Note 3, probably worth just going and have a look at note 3 and see what that is. Is it sustainable? Why is it not classified as a proper sale? So sales tends to be our kind of our core business, whereas other income will be kind of, additional information, income, maybe unearned income, for example. And so we got other operating income. Here we go. So it's European Space Agency contracts. Now, why that would be classified as other operating income rather than core revenue or sales, I don't know. But anyway, that's how they've classified it. So I put it in as my sales figure because I got nothing else to. I
would suggest. Ted, I would suggest because of those 4 satellites that they have, there could be some contractual things that they're doing with the European Space Agency. But
absolutely,
but it could be not a core part of cybersecurity income, which is probably how they've tagged it. But
yeah,
that's my inference from that.
That may well be right. So anyway, there we are. So we got our other operating income. The admin expenses, £2 million. There they are. Quite an increase on the previous year. So their revenue has increased by 57%, or their other operating income has increased by 57%, and their costs have also increased substantially. They're operating at a loss. They got some finance costs. Now, quite interesting here, you'll notice the finance costs have gone up substantially and the finance income has gone down substantially. So this suggests to me that they've got significantly less cash and significantly more debt sitting on their balance sheet. And we will confirm that when we look at their balance sheet. Anyway, the net effect of that is to turn what was an operating profit from the previous year into a loss for this year. They get a tax refund. Okay, they've been having tax refunds both years because of their loss making. So they're still making a loss, but it's not quite as bad as the kind of the operating loss because of that tax rebate. So 29%. Now the post from David Best said that potentially gross margin of 90%. Now that kind of makes sense if you think about it. From a company, if they supply cybersecurity, all they've got to do is to have the systems in place. It's not like they have to sell, padlocks like a kind of a normal security system. So, once all the systems are in place, it's just a subscription-based model. So 90% is certainly, not unrealistic if they can get the clients on it, if they have a proof of concept. So right now, it's not looking too good. So they are making a loss. Here's the balance sheet. So a couple of things to notice in the balance sheet. Now, the first thing to notice here is a big increase in their intangible assets. Okay, so now these are the non-current assets. These are the things that they need to run the business. Intangible assets, things you can't touch. Now, note 10 will give us some more information about this, and we'll go and have a look at note 10 because this is a pretty substantial number. And what we're going to find in note 10 is that these guys, they're developing their own software. And in effect, what they're doing is they're capitalizing their own costs. So here we see the additions, 3.5 million up to the kind of, the net book value this year. There's no amortization. They're not, amortization is depreciation by another word. We amortize intangibles, we depreciate tangible assets. So what these guys are doing, they basically got, lots of programmers, lots of techie people who are sitting around kind of doing all their programming and all that sort of technical stuff. They're creating this cybersecurity. It's an intangible. And what they're doing is they're capitalizing their costs. It's a bit like saying, I've paid Fred $100,000 for the year, and he's created me $100,000 worth of software, which I'm going to benefit from in the future. And therefore, I'll capitalize it and I'll put it on the balance sheet. So these costs are costs to the business in terms of cash flow, but they're not affecting the profit and loss account. So when we look at this profit and loss account, if we were to include the development costs, which are being capitalized, then you would see a very different number. let's go back to our profit and loss account. So in effect, this profit and loss account here, so these administrative costs, this £2 million of administrative costs does not include the £3 million of development costs, which are actually being put onto the balance sheet. So just so we're aware of that. So a significant amount of investment going in, and that's really where that kind of that investment is landing. You know, these are staff who are being paid to develop the software. Current assets, as we'd expected, they had quite a lot of cash at the end of last year, 3 million, and they have next to no cash this year. So the cash has gone down. And as we also expected, their liabilities, their borrowings have gone up. So they went from, if we look at last year, they had about 2.7 million in long-term borrowings. That has turned into £4 million of short-term borrowings. Now, this causes a little bit of a problem, because if you start to kind of do your liquidity ratio, the old standard, you suddenly find that this is a very, very big mismatch. Okay, so if you've got a company, a traditional company with £370,000 in the bank and it owes £6 million, it has a liquidity issue. So these guys are clearly going to be going back to the shareholders, knocking on the door and say, we need more money. Okay, and that will have been something which will have happened, you know, since these accounts were put together. Because if it hadn't happened, these guys would not be around anymore. So we expect to see that in the next set of accounts. So debt has gone up. We saw that because the interest payable has gone up. The cash has gone down. We saw that because the interest income has gone down as well. And the net effect of those two, if we scroll down to the bottom half of the balance sheet, is to see that the balance sheet has significantly withdrawn. So the amount invested hasn't changed, but what we have seen is a big loss, and therefore the net asset value of this business has gone from £1 million down to 720. Okay, and that's effectively what's going on there. So just to summarize, increase in intangibles, that's our development fees, a fall in cash because they've been spending lots of money on all these developers. The short-term borrowings, you know, they've got liquidity issues, if we read the balance sheet correctly, and the long-term debt has become a short-term debt. Also, what we've also got in here, you'll notice, is these convertible loan notes. Now, this is interesting because they say treated as equity. Now, this is an important aspect. So let me just clear my annotations. So these loan notes, this is effectively a note, and it's a convertible loan note that says, I've lent you some money, it's debt, but as the lender, I have the option to convert that into equity. Now, what we can't see in these accounts is the rate at which it can be converted into equity. So, you know, we kind of need to make sure as an existing shareholder that I'm not going to be diluted by, you know, somebody who's lent money, just converting it, you know, at a very preferential rate, and suddenly my equity investment is significantly diluted. If this is a loan note, if this is a pure loan note, this should obviously be sitting in here. And if you put it in there, then this net assets effectively goes down by £1 million and becomes therefore negative. So that goes to a negative. So they've basically classified it in here because they really want to show a positive balance sheet. Okay, so, you know, there's a kind of, you know, there is an argument that says you could put it into liabilities. They said we've been conservative, we put it in as equity, but that means that they no longer have a, you know, they don't have a negative balance sheet, and that I think is an important aspect for them. Those loan notes, so they, you know, that if you're interested in them, there's kind of a little bit more information about them on note 21. Probably worth just having a little squiz at note 21. So here we are, deep in the notes to the accounts, and the note 21 gives us a little bit of information. Here we go. So this tells us that the convertible notes, and it's really just treating them as equity. But what it doesn't give us is any information on, you know, what rate are they convertible at, you know, how much dilution, what kind of diluting effect will they have on existing shareholders, which, of course, if I was an existing shareholder or a potential shareholder, I would be interested to know. So there is the balance sheet. As for the cash flow, if we go and look at the cash flow statement, Here's the retained earnings. Nothing really exciting going on in there. They're making their losses. They're sitting on retained losses. That's absolutely fine, as we'd expect. Here, this is quite interesting. So these guys, what you'll notice is that the cash, they've got positive cash flow last year and negative cash flow this year. Okay, there's a kind of little bit of a question around here, and actually the note 15 tells us about the reconciliation between the profit or loss and the cash flow. And I think again it's worth actually having a look at that note 15 to find out exactly what is going on. So probably more than usual, Moe, we're kind of bouncing into the notes of these accounts, and these notes are important. So let's look at this year. They make a loss of 900,000. What you see here is a change in trade and other payables. Okay, these are people to whom you owe money. They've paid $1 million. Okay, they paid $1 million, and effectively they bought. They've been paying off their suppliers, and that's had a negative. Right? Sorry,
£1 million.
Sorry, £1 million. Yeah, did I say dollars? Yeah, £1 million. Yeah. I was in dollars this morning, so that's I'm getting my currencies mixed up. But yeah, so they paid £1 million. So their negative cash flow is basically the loss from this year plus the £1 million that they've paid to their suppliers relating to unpaid bills. Now, the reason for that is that the previous year they had a positive cash flow of 3 million, and that positive cash flow was driven by the fact that they weren't paying their suppliers. So if you're a supplier to this company, then you've got to be ready for a bumpy ride. These guys are not very good at paying their bills, and they will use you to finance their business. So eyes wide open on that one. So here we see that they make a profit up here. They have this trade and other payables, which is effectively they're not paying their bills, and that's why they make a nice big juicy cash profit. Their underlying, really, I think we can kind of if we strip out these two numbers here and really try and look at the kind of the fundamentals, these guys are basically their cash flow is pretty close to their profit. So these guys they're burning cash, and they're burning cash at nearly £1 million a year. So if you're burning cash at £1 million a year and your year-end cash balance is 150,000, there it is, just to highlight it. So the cash at the end of the year is 150,000. Then it's basically saying you're going to run out of cash very, very quickly. And that's what these guys are going to do, and therefore they will have been back to the market to raise more money, either through additional debt, which is unlikely because I think they got enough debt right now, so they've probably gone back to the market and raised more money through equity because they have no cash left. And I think that's those are kind of the key numbers for me. So this is very much, this is a jam tomorrow investment. This is a jam tomorrow stock. These guys, they're making losses. If our friend David Best is right, and they're going to make a 90% margin and take over the world, then this is definitely you fill your boots, and these guys will make a lot of money. But this is very much they've got to come up with their proof of concept. They've really got to be able to show that they can actually deliver, and they can start generating any revenue at all. Just give me some revenue on that top line. That kind of leads us, I guess, on to the share price. So we're going to have a look at the share price. Here it is. So this was yesterday's share price. Actually, it may have changed. $22. Not sure we can really sort of comment on that. The market cap is 3.09 billion. So just to put that into perspective, they're making a loss. So there's no PE ratio. There's no yield. They are trading. So 3.09 billion. On a net asset value of 720,000, which is their balance sheet, which I think should be negative anyway, should be negative. Basically says they're all goodwill. The whole thing is just goodwill. It's just a massive punt. Now, I'm not saying it's not a punt that's going to come off. They're trading on 2,000 times sales if we take their other operating profit as sales. So market valuation, you can almost say they haven't put these figures on the website because they are meaningless. This is all jam today tomorrow. This is all about speculation. it just looks very, very expensive. Maybe I'm going to eat my words. Maybe this is the opportunity to buy in now and you're going to make your fortune. But this is not, this is certainly not for widows and orphans. This is not sell your house and put it all into this stock, unless you know something that I don't. So for me, this is a very high risk investment, and really, if you're investing, if you're buying into this, you're not buying into the financials of this company. You're buying into the story and the fact that you're convinced that their product is great, it's scalable, it's gonna fill the gap in the market, and it's gonna create this security system that no one else can match and becomes the industry standard, etc., etc., etc.
Yeah, so this would be in the punt portion of your portfolio for sure. But yeah, very interesting set of financials. And like I said, you can see that there right in front of you, kind of quadrupled almost in the space of 4 months, and then dropped back again by about another 50%. So interesting to see that, but very early days for this company. So let's see if they, and it's a shame that we couldn't find their quarterly financials. I couldn't find them on the website either, which I found surprising.
They're not producing quarterly financials, and I don't know why. It's quite interesting.
Yeah.
For me, if a company wants my money, it's a bit like buying a second-hand car and the chap saying, no, you can't look under the bonnet. And I'm like, yeah, you've got to look under the bonnet because that's what you're buying.
Yeah, and particularly for a publicly traded business. So I just thought that was very surprising to not find that on their website. But, maybe someone else can find that out for us. And, if there's anyone watching this that happens to know some information about this business, or know a bit more about the technology and the symmetric keys and the space that they're playing in, we would love to hear your thoughts. So do please share your comments. Share your thoughts in the comment section below. And again, if you have a company you'd like us to analyze, again, leave a note in the comment section. We will get round to it. And as you saw in the previous slide, we probably get round to these within 3 to 4 weeks. So we do have quite a fast turnaround. Hopefully that continues, unless we're flooded even more. So until the next video, thank you, Ted. Thank you everyone else for watching. We'll see you soon.
Good to see you, Moeed. Catch you later.